If you choose the wrong trading type as a beginner, you can blow up your account in days. Not because crypto is a scam, but because you picked the wrong trading type. Today, I'll show you the real difference between spot and futures trading with simple examples using Bitcoin and help you decide which one is right for you. No hype, just facts. Spot and futures look similar on the screen. Same charts, same candles, but the risk level, completely different. Let's break this down clearly. What is spot trading? Spot trading is simple. You buy a coin, you own it. If Bitcoin is $40,000 and you buy $1,000 worth, you now own Bitcoin. If Bitcoin goes to $44,000, you make 10%. If it drops to $36,000, you're down 10%. But here's the key, you cannot get liquidated. Even if Bitcoin drops 50%, you still own your coins. Now imagine a real chart. Bitcoin dips from $40,000 to $35,000. In spot, you're down, yes, but you can wait. If price recovers to $45,000 later, you profit. That's the power of spot. Time is on your side. Pros of spot: lower risk, no liquidation, simple to understand, good for long-term investing. Cons: slower gains, requires more capital for bigger returns. Here's where most beginners mess up. They get bored. They see slow gains in spot and jump into futures thinking it's faster. Let's talk about that. What is futures trading? Futures let you trade with leverage. Leverage means borrowing money to increase your position size. Example, Bitcoin is at $40,000. You use 10 times leverage with $1,000. Now you control $10,000 worth of Bitcoin. If price moves 5% in your favor, you make 50%. Sounds amazing, but here's the other side. If Bitcoin drops just 10%, your position can be liquidated. That means your entire $1,000 is gone. Not down 10%, gone. On a real chart, small moves happen daily. A 5 to 10% move in Bitcoin is normal volatility. In futures, normal volatility can destroy you. Pros of futures: higher profit potential, can short, make money when market drops, capital efficient. Cons: liquidation risk, emotional pressure, over-trading temptation, funding fees. This is the part nobody tells you. Futures doesn't just test your strategy, it tests your emotions. Best beginner entry path. If you're new, here's the smart progression. Step 1. Start with spot only. Learn how charts move. Understand support and resistance. Practice position sizing. Step 2. Never invest money you can't afford to lose. Step 3. Use stop losses even in spot for swing trades. Step 4. Only consider futures after at least 3 to 6 months of consistent discipline. You understand risk per trade. You never risk more than 1 to 2% per trade. And if you try futures, start with 2 times or 3 times leverage. Not 20 times, not 50 times. High leverage is gambling. Low leverage is controlled risk. Here's the uncomfortable truth. Most beginners don't need futures. They need patience. Common mistakes to avoid: using high leverage for quick money, trading without stop loss, risking more than 5% on one trade, revenge trading after a loss, copying influencers blindly. Discipline beats leverage every time. Before you place your next trade, ask yourself, am I trading for skill development or chasing fast profits? That answer will decide your future in crypto. If this helped you understand the difference clearly, like the video, subscribe to BitBlastCoin, and comment below. Are you starting with spot or futures? Stay disciplined. Protect your capital. I'll see you in the next one.